Thank you for joining us on how to sidestep market losses in your red money. In our video 3 diversified charts, we talked about the 4 colors of money: green, yellow, red, and gray. Green and yellow are risk-off savings vehicles. Red and gray are risk-on investment vehicles. One of the 4 investment classes we call a red money. That would be stocks, bonds, commodities, and currency investments. The good thing about red money is that the investments are liquid. They have a daily price, and you have a potential to achieve attractive returns. The bad thing about red money is that there's no loss protection. You can lose money. The ugly thing about red money is that sometimes you can really lose a lot of money. So if you want some of your money in red investments, many ask us, hey, is there any way to reduce my downside risk in my red investments? To which the answer is a definite maybe. You can choose from 2 different styles of management for your red investments. One being passive, also known as buy, hold, and hope. The other is active, which is also known as tactical trading using technical analysis. What the heck does that mean? An example of passive investments would be buy, hold, and hope. In this diagram would be you buy, in this case, the S&P, and you simply hold it. So prices go up and down. There's a daily value, but you hold on to this vehicle and don't make any sales or purchases. Passive does nothing. Active would sell when in red and buy in green. So if you choose an active manager who uses technical analysis, for example, in this is the 12-month simple moving average, it would look like this. They would sell when it was red, buy when it was green. So instead of buying and holding this whole period and hoping prices go up, you are actively taking a participation in the selling of the vehicles at certain times. If you choose an active manager who uses technical analysis, typically they will also use tactical trading, which is selling stock or some other vehicle and buying a different asset. What the heck is tactical trading? Well, it's based upon the nautical maneuver of tack or tacking. It's when you turn the bow of a sailboat through the wind, so the wind changes the side of the sail and propels you to your desired direction. You know, where the wind's coming here, you turn to the right, you're directly into the wind, and then the wind catches the other side and straighten out your rudder, so it takes you in that direction. If you choose an active manager who uses both technical analysis, as we saw before, and tactical trading, you will have these same trades on a technical basis, but your chart on a tactical basis, once it's combined with technical, looks like this, where a buy and hold value will go up and down. The tactical, technical, active manager will go to a money market and back into a growth fund, into a money market, back into a growth fund, money market, growth fund, money market, etc. This is a hypothetical. Performance does not guarantee any results or performance. It's just as a theory on what an active manager may be able to do. My name is Tom Fay, and we've been active managers for our clients' red money for the past 25 years. Many people ask us, could I have different rates of return on my red money between active and passive? Maybe, yes, you could. Can an active or passive manager guarantee positive returns? Absolutely not. No asset manager can guarantee you positive returns in red money because there's no principal protection. Can an active manager reduce the risk of my red account? A definite no. Not if you stay in the red money, and most people don't understand this. These are at-risk assets. The risk is on. If people say, oh, I'm more conservative now because I went from stocks to bonds or commodities to stocks or currency to bonds, you did not reduce your risk. You transferred your risk from one risk asset to another. It may not mean you reduced your risk. As a matter of fact, you could have increased your risk. But you did not negate your risk. You just transferred your risk to a different vehicle. Can an active manager reduce the risk in my total account? And that's a definite yes, but only if the manager is allowed to use the green and yellow money. If you are constantly transferring your assets between stocks, bonds, currency, and commodity, those are risk-on vehicles. There is no principal protection. But if the manager is allowed to move money into a cash money market, for example, that's a risk-off vehicle. And yes, your risk will be reduced because your asset will not be in a risk-on vehicle. Hey, I hope you found this short clip informative. If you want to take advantage of our 20 years of experience with sidestepping market losses in your red money to help achieve your specific financial goals, hey, just fill out the form above for an appointment. God bless America and enjoy your day.